The Alchemy of Finance. Reading the Mind of the Market by George Soros, foreword by Paul Tudor Jones II. This is a book summary. Today we're diving into the mind of one of the most legendary investors of our time, George Soros. You might know him as the man who broke the Bank of England, making a cool $1 billion in a single day. But behind those jaw-dropping moves lies a philosophy that's even more fascinating than the financial gains themselves. Soros isn't just a trader, he's a philosopher of finance, a man obsessed with the unpredictable nature of markets and the even more unpredictable nature of human behavior. So grab your notepads, because we're unraveling the secrets of The Alchemy of Finance, a book that's not just about making money, but about understanding the very fabric of reality as it twists through the lenses of perception, fear, and greed. Soros's Theory of Reflexivity challenges everything you think you know about economics. While most investors treat the market like a predictable machine, Soros sees it more like a chaotic ocean, where waves of perception create ripples that can turn into tsunamis. This isn't some dry academic theory. Soros has battle scars to prove it. From betting against the British pound in 1992 to navigating the chaos of the 1987 crash, he's tested his theories in the furnace of the financial markets and lived to tell the tale. It's like if Sherlock Holmes stopped solving murders and started shorting currencies instead. But there's more to this story. The Alchemy of Finance isn't just a book. It's part memoir, part manifesto. It's Soros wrestling with his own doubts and mistakes, revealing how even a billionaire investor can struggle with self-doubt, confirmation bias, and the agony of being wrong. We're talking about a guy who admits that the pain of losing money sometimes clouds his judgment, a guy who turned that pain into one of the most profound critiques of modern economics. This book is about peeling back the layers of reality itself. Soros argues that markets aren't driven by cold, hard facts, but by the stories we tell ourselves about those facts. It's a bit like Inception, but with interest rates and stock options instead of spinning tops. If you've ever looked at a stock chart and thought, this doesn't make any sense, well, Soros would say you're right, and he'd tell you why. Part 1. The Alchemist's Philosophy. George Soros didn't just want to play the market. He wanted to understand it. He wasn't satisfied with the idea that prices move because of some rational, invisible hand. No. Soros believed that markets are driven by something far more chaotic. At the core of his philosophy is something he calls the Theory of Reflexivity. Now, I know what you're thinking. Reflexi what? Stick with me. This idea isn't just a twist on traditional economics, it's a full-on rebellion. You see, most economists believe that markets tend to balance out, like a seesaw finding its center. But Soros? He says, nope. Markets, he argues, are more like living organisms, messy, unpredictable, and constantly mutating based on our own flawed perceptions. So what is this reflexivity thing all about? Imagine this. In traditional economics, prices are supposed to reflect reality. Supply and demand, earnings, interest rates, all that jazz. But in Soros's world, prices don't just reflect reality, they shape it. It's like looking in a funhouse mirror and then stepping into the reflection. If enough people believe that a company's stock is worth more, they'll buy it, pushing the price up. That rising price then makes the company look stronger, which attracts more buyers. It's a feedback loop, and it can spiral out of control, up or down, like a financial Frankenstein. And this isn't just some theoretical mumbo-jumbo. Soros put his money where his mouth was, time and time again. Take the international debt crisis of the 1980s, which he dissects in The Alchemy of Finance. While most analysts were lost in spreadsheets and balance sheets, Soros was watching the way banks were thinking about debt. Banks believed these countries could pay back loans because they were willing to keep lending, which made the debt ratios look healthier. Until they didn't. When that belief collapsed, so did the loans. It was reflexivity in action, and Soros was ready for it. He even compares this market madness to alchemy, the medieval pursuit of turning lead into gold. Why? Because just like those old-school chemists, Investors are out here trying to transform their theories into profit, even if those theories are fundamentally flawed. Soros argues that the market isn't some cold, rational machine, it's more like a collective hallucination. It's not about what is true, it's about what people believe to be true. And when enough people believe in the same illusion, that illusion becomes reality, at least for a while. Soros doesn't just tell us that the market is irrational. He shows us how to live in that chaos. In The Alchemy of Finance, he reveals his own struggles. The second-guessing, the self-doubt, the pain of losing money. He talks about how he would literally get back pains when he was about to make a bad trade, like his body was rebelling against his mind. That's right. George Soros, billionaire investor, was out here making billion-dollar bets based partly on back pain. Talk about high-stakes hypochondria. And this is what makes Soros so fascinating. While most investors worship efficiency and equilibrium, Soros worships uncertainty. He says that recognizing your own biases is the first step to surviving in a world where perception is reality. It's about embracing the chaos, not fighting it. Markets, in Soros's view, are like storms. Not something to be understood and controlled, but something to be navigated with a mixture of science, intuition, and yes, a bit of alchemy. So, are markets rational? Or are they just a collective illusion held together by our hopes, fears, and greed? Soros would say the answer is obvious, and it's the key to his billions. Part 2. The double-edged sword of reflexivity. Soros says that our beliefs can actually change the fundamentals of the markets. Not just influence them a little, change them. Think about that for a second. This isn't just about price movements. It's about reality itself shifting based on what people think is true. It's a two-way feedback loop. Perceptions shape reality, and reality, in turn, influences perceptions. Imagine a stock that starts rising, maybe because of a promising new product or just a rumor that won't quit. People buy in, the price climbs higher, and suddenly, the company's borrowing power explodes. Banks are practically throwing money at them, and executives start expanding, opening new offices, launching new products, because hey, the market must know something they don't, right? But here's the twist. This growing confidence can lead companies to expand recklessly, piling on debt and stretching themselves too thin. It's like building a skyscraper on sand. Eventually, someone looks down and realizes the foundation isn't as solid as everyone thought. Panic sets in, shares start to drop, lenders get nervous, credit lines dry up, and suddenly that skyscraper starts to sway. The bubble bursts, and down comes the house of cards. This isn't just a theory, it's a cycle we've seen play out again and again, from the dot-com crash to the 2008 financial crisis. And Soros didn't just theorize this, he lived it. In 1992, he pulled off one of the most legendary trades in financial history. Britain was clinging to the European exchange rate mechanism, trying to prop up the pound against the German mark. The government was hiking interest rates, burning through reserves, and making increasingly desperate moves to defend the currency. Most investors were scared to bet against it. After all, you don't take on the Bank of England and live to tell the tale. But Soros wasn't most investors. He saw that the government's resolve was an illusion, a facade held together by little more than wishful thinking. So, he went all in, shorting more than $10 billion worth of pounds. When Britain finally caved and let the pound float, it plummeted. Soros walked away with a cool $1 billion in a single day, earning himself a new nickname, the man who broke the Bank of England. But here's the thing. Soros's point wasn't just about making money. It was about proving that our perceptions can force reality to bend, at least for a while. The British government believed they could maintain the pound's value, which convinced others to believe it too, until Soros called their bluff. In that moment, the illusion shattered, and reality snapped back with a vengeance. It was reflexivity in action, a perfect example of how beliefs can create temporary realities that eventually implode. And it's not just governments or markets that fall into this trap. In The Alchemy of Finance, Soros dives deep into how entire eras of financial history are shaped by these feedback loops. Like the international lending spree of the 1970s, when banks were so convinced that developing countries could repay their debts that they kept lending more until the borrowers were drowning in it. Or the 1987 crash, when a decade of runaway optimism came crashing down in a single brutal day. Soros calls this the boom-bust pattern, an almost mythical cycle where perception drives reality until reality can't keep up. First comes the spark, some new technology, a promising market, or a government policy. That leads to a self-reinforcing boom, where rising prices justify themselves and anyone who dares to question it gets steamrolled. Then, just when the hype seems unstoppable, reality strikes back. Investors panic, prices plummet, and the feedback loop goes into reverse, spiraling down until the last bit of illusion is wrung out. And Soros isn't shy about admitting that he's gotten it wrong too. He talks openly about the times when his perceptions were flawed, when he held onto positions too long, or misread the feedback loops. That's what makes his story so compelling. He's not some ivory tower theorist. He's a man who bet billions based on his understanding of how perception shapes reality. And, more importantly, how quickly that reality can fall apart. So when Soros says that markets are like living organisms, messy, unpredictable, and shaped by our beliefs, he's not just spinning a metaphor. He's describing a battlefield where reality is whatever the strongest narrative says it is, until someone like Soros comes along and breaks the spell. And that, my friends, is what makes The Alchemy of Finance such a powerful book, not just for investors, but for anyone trying to understand how the world really works. Part 3. The real-time experiment. Here's where Soros gets even more interesting. In The Alchemy of Finance, he does something you almost never see from billionaire investors. He opens up his playbook in real time. No cherry-picked success stories, no edited highlights. Just raw, unfiltered thoughts as he navigates the chaos of the markets. Soros called this his real-time experiment, but it's more like a financial diary. Except this diary doesn't just have scribbles about crushes and bad days at school. It's got billion-dollar trades, sleepless nights, and a running commentary on the madness of the markets. He started this experiment in August 1985, a time when the world was grappling with runaway inflation, currency volatility, and a mountain of international debt. Soros wasn't just sitting on the sidelines watching. No, he was in the trenches, making bets that could have sunk entire nations. And here's the wild part. He wasn't even sure he was right most of the time. He writes about second-guessing himself, about getting physically ill when he sensed a trade was going wrong. This wasn't some Wall Street cowboy bragging about his wins. It was a man obsessed with understanding the truth, even if that truth meant admitting when he was completely off base. And the stakes couldn't have been higher. We're talking about trades that swung hundreds of millions of dollars on a single decision. 1 minute, he's making a killing betting on the devaluation of the Mexican peso. The next, he's writing about the pit in his stomach as the market turns against him. This wasn't just a battle against the markets, it was a battle against himself, against the fear and greed that lurk in every investor's mind. Soros knew that the biggest enemy wasn't some anonymous trader on the other side of a Bloomberg terminal, it was his own biases. His real genius was recognizing just how flawed and chaotic they really are. Most investors cling to the idea that markets are efficient, that prices reflect all available information at all times. Soros looked at that idea and laughed. He saw markets as a hall of mirrors, reflecting not just economic fundamentals but the distorted beliefs of millions of participants, each with their own biases, fears, and agendas. It's like trying to read a map while other people are constantly redrawing the streets. Soros's real-time experiment was his way of proving that the map was never right to begin with, that the streets were always shifting based on what people believed. He documents how a small rumor could send a currency into freefall, how a single speech by a central banker could spark a frenzy of buying or selling. It wasn't about what was true, It was about what people thought was true and how that perception shaped reality. And Soros isn't shy about showing his scars. He writes about getting burned by the Japanese yen, about times when he held on to losing positions out of sheer stubbornness. There's a moment in the book where he confesses to ignoring his own rules, doubling down on a bad bet, because he couldn't admit he was wrong. We've all been there, whether it's holding onto a losing stock or refusing to fold a bad hand at poker. The difference is, Soros is doing this with a kind of money that could fund small countries. But here's the twist. Every loss, every mistake was just more fuel for his theory of reflexivity. The idea that markets aren't rational, that they don't naturally return to some balance point like a pendulum. Instead, they're more like a rubber band stretched to its limits, either snapping back violently or breaking altogether. Soros wanted to understand those snap points, those moments when perception and reality collide with explosive force. Soros even says that the most important skill for an investor isn't knowing when to buy, but knowing when to cut your losses. That's a hard truth to swallow, but it's the kind of truth that keeps you in the game when others are wiped out. So when Soros writes about the pain of losing money, he's not just talking about the financial hit, he's talking about the emotional toll, the self-doubt, the nights staring at the ceiling wondering if you've lost your touch. That's what makes this book so gripping. It's not just about numbers and charts, it's about the human mind, about how easily we can fool ourselves and how hard it is to see the world clearly. Part 4. The lessons for investors. So, what can we learn from Soros' Alchemy? Well, it's not about finding some secret formula for beating the market. It's about understanding the game itself, the invisible currents that move prices and people alike. Soros' wisdom is like a survival guide for anyone trying to navigate the stormy seas of finance. So grab a pen, because these are the big takeaways that could mean the difference between cashing out and crashing out. 1. Embrace uncertainty. Most investors cling to the idea that markets are rational. Soros says, nope. Markets aren't logical. They're emotional, impulsive. Prices don't move because of some hidden law of nature. They move because of us, our fears, our hopes, our greed. In The Alchemy of Finance, Soros tells us to stop looking at markets like scientists and start looking at them like psychologists. It's not enough to study the numbers. You've got to study what people think about the numbers. During the 1980s international debt crisis, Soros wasn't just watching the debt-to-GDP ratios, he was watching how banks thought about those ratios. It's that shift in perception that turns manageable debts into financial avalanches. So next time you're watching CNBC and the talking heads are arguing about price-to-earnings ratios, remember, it's not the numbers that matter. It's the stories we tell ourselves about those numbers. Embracing uncertainty means accepting that no model, no chart, no algorithm can fully capture the chaos of the markets. 2. Survival first, profits second. If there's one thing Soros makes clear, it's that the market is a brutal place, like a casino where the rules change halfway through the game. His mantra? Survival first, profits second. Forget about hitting home runs. Focus on staying in the game. Soros talks about cutting losses quickly, even if it means swallowing your pride. Soros has made more money from knowing when to cut his losses than from holding on for big wins. 3. The feedback loop. Now, this is where things get really interesting. Soros' theory of reflexivity isn't just about how perceptions influence markets. It's about how you might be influencing the market without even realizing it. Picture this. You hear that tech stocks are the next big thing, so you buy in. So do thousands of others. Prices soar, attracting even more buyers. Before long, the bubble gets so big that the fundamentals don't matter. Until they do, and the whole thing comes crashing down. In The Alchemy of Finance, he describes how he used this feedback loop to bet against the British pound in 1992. By shorting the currency, he wasn't just betting that it would fall. He was making it fall by triggering a cascade of other traders doing the same. It's a masterclass in how to weaponize reflexivity, turning the market's own emotions against it. Understanding Soros's reflexivity is like discovering gravity. You might not control it, but you can learn how to fall without breaking every bone. The trick isn't predicting what the market will do next, it's understanding how it reacts to its own reflection. Part 5. The bigger picture. In the Alchemy of Finance, Soros argues that the same flawed perceptions that drive financial bubbles can also drive revolutions, wars, and societal change. Think about it. Just as investors chase rising prices until the bubble bursts, entire nations can chase ideologies until the harsh reality breaks the spell. Soros saw this firsthand, growing up in Nazi-occupied Hungary and later witnessing the rise and fall of the Soviet Union. He didn't just survive history, he studied it, dissected it, and found the same patterns of reflexivity that he saw in the markets. He believes that our perceptions of political realities can create self-fulfilling prophecies. For example, when a population starts to lose faith in its government, that fear can spiral into protests, uprisings, and eventually regime change, just like a market crash. And the most dangerous part? When governments respond to threats with crackdowns, it only reinforces the public's fear, accelerating the very collapse they were trying to prevent. So whether you're trading stocks or just trying to make sense of this crazy world, the lesson is clear. Question everything, especially your own beliefs. Because in a world driven by perception, the only way to see clearly is to challenge the lens you're looking through. Soros's ideas might not make you a billionaire overnight, but they might just help you survive the chaos of both markets and life. If you want to dive deeper into Soros's world, hit that like button, subscribe, and let me know in the comments. What do you think? Are markets efficient, or are they just a reflection of our own madness? And hey, if you've got a story about a time your perception turned out to be way off, whether in trading, politics, or just life, drop it below. After all, we're all trying to figure out how to turn our own lead into gold.